Hey, Becca Jane. Drew, you're still on mute, mate. Can you hear me at all?
Yeah, I can hear you. Can you hear me?
Yeah, got you now, mate. How are you?
I'm just in a noisy place. Sorry.
That's all right, my friend. No worries at all. No worries at all. How are you? You all good?
Yeah, good, thanks.
Okay, awesome. Awesome. Well, welcome to the 2026 budget roundup. From my perspective, it's a pretty shit budget roundup, but I don't think it's the best thing for the country that we've had. But we've been able to get a whole. You're the only one that's joining us today, so welcome. Uh, we have managed to go out and look at a lot of questions people are wanting answer to from the budget. So Becca, who's my business partner within Resolute U, is has collated the questions and she's going to ask them. Mate, if you've got anything that you want asked or to ask or clarify, you just let me know and we'll answer those as we go. The questions that we've got are pretty much the ones that the rest of Australia is looking at. So it might cover you off or it might not, but you let me know if it doesn't. Becca Jane.
Okay, great. Hi, Drew. So, Daniel, Sarah, who is on the long game with us, has actually asked a question with regards to um, with the current budget changes and cost of living pressures, what are the smartest things small business owners should be focusing on financially right now to create more stability and long-term growth?
Yeah, that's a really good question, Becca Jane. That's a really, really good question. Being a small business owner, or us being in a small business and me having my own financial planning practice, um, looking after pennies for the pounds to take care of themselves is ultimately what it always comes down to. A lot of the tax cuts, especially some of uh, the the Australian tax workers offset that's coming in 2028, um, doesn't usually won't probably go to a small business owner unless they pay themselves but wages from a company. Um, the $1,000 write-off is for workers as well. So from a small business perspective, it's all about our capital allocation, what we're spending, why we're spending it, and making sure that we're spending it correctly. Because I've noticed my costs have dramatically increased through my business, and we just have to run it as skinny as we can until we see where the economic environment takes us. But it's that control of your expenses is going to be the most important thing. You can't control what income comes in, but you can definitely control what goes out.
Yeah. And I think that's a really important one is just to really know what your capital allocation is. So thanks for that, Dan. Um, Claire actually was just talking about the what's changing with capital gains tax for property investors.
Yeah, this is a really big one. What I might do is share my screen, and then what that'll do is it will bring up the presentation that we did a couple of days ago. That's now going to have a look at what's going on for the property investors. So I'm just going to bring up the right slide. Okay, I'm going to hide some stuff. Alrighty. So property tax. What's the new rules actually means for investors? So from 1 July, you cannot deduct any losses against wages and salary. So that's 1 July 27. It's quarantined. What they're doing is that's going to go into a residential property loss pool. So it's a separate account. So the accountants are going to be happy with it because it's another box they get to tick and another box they get to charge for. That's tracked for that specific property. So how you use it, the loss pool can offset A, future rental income from this or other properties, or B, the capital gain when you sell. I'm just going to go quickly back to the first one. The loss pool can offset A, future rental income from this or other properties. One of our participants on the long game, she has a investment property at this moment that is going to be cash flow positive to the tune of about $10,000 come October once all debt's paid off. So under the new rules, if she decides to go and buy an investment property now moving forward, and it's not a new property, any of those losses that she would incur owning that new property, this income from her existing property can actually be used to offset that loss. So that's actually, that's beneficial if she wanted to buy an existing property. She's able to offset her income from this investment property she's got now to offset it against a future property. So that's what part one is, future rental income from this or other properties. And two, the capital gains when you sell. Now, this is a little bit tricky, and I've been seeing some stuff float around across social media that's misinterpreted this rule. Uh, this does not get added to the cost base of the property. If you own a block of land, for example, under the existing rules as we speak of today, if you incur rates and maintenance and any other costs associated to that block of land, because it doesn't generate an income, you can't offset it against any of your, you can't offset the losses against your income. So what happens is those losses, and I'm going to pull a figure, let's say they amount to 5 grand a year. They continue to add to the cost base of the block of land so that when you go to sell it, your cost base is a lot higher. So you end up paying less tax on it. That's having the capital losses carried forward. This is not what it is. You effectively have it on your revenue side of your profit and loss. Sorry, Drew, for nerding out. You have it on your revenue side of your profit and loss account. And then when you go to sell the property, you get to offset that loss against the taxable gain after we've worked out what the gain is. So you do get to actually reduce your tax, but it's not from reducing your capital base, it's from reducing the assessable income that gain's generated. So it's a lot changed since, it will be changed significantly since budget night. And that will catch out a lot of people. If they think it's going to add to the cost base, that's going to be incorrect. And if they do their own tax, well, they're going to do that wrong, and the tax office will be looking, and then they'll need to redo their tax return and maybe pay extra money to the tax office. So it's from a CGT investment, it's not that good. From a position of buying a property moving forward, the only way that you can carry forward any losses against your income or utilize the losses against your income is if you buy a brand new property. If you buy a brand new property, you get to do the negative gearing as we've known prior to budget night. So that's good. That will stay into effect. The CGT, you also, because you've bought a new property, you get to choose whether you want to use the 50% discount or use the indexation and the flat 30 cents in the dollar capital gain. So that at least allows us to plan about what people are going to do and how we do it, and we can give them some advice around that and a financial planning prospect. I think there's going to be a whole heap of unintended consequences from this. People who own existing properties who may have looked to turn them over and to buy things, if they can only buy new properties to get the benefits. So if they've got stock that they hold, that may not free up any extra properties to come on the market for first home buyers. And all new developments now moving forward will be impacted by, well, that's the only thing that investors can buy to get the tax deductions. So they may be also then shut out of that market because investors are going to go to it. So a bit of a dog's breakfast. Keating tried this in 85. They think the difference between now and 85 is they've grandfathered the old rules where Keating hadn't. He said it's just now, if you've had it previously, this is the new rules for every property. 18 months later, due to rent rises, he had to unwind that rule. Pretty much every other tax district across the world who have tried to bring this in has had to unwind it a couple of years after they implemented it. So I'm not sure why we think it's going to work here, but the proof will be in the pudding and we'll see where we lay. Has that answered Claire's question, do you reckon?
Yeah, I think so. And I think there's probably something that follows onto that is like with the capital gains changes, does it actually cause like existing investors to hold their properties rather than to sell? And what would that do to the supply then?
Well, if they've got no reason to hold, they'll to sell, then they'll hold them. The CGT rules are still grandfathered as they are under the existing properties. So there's no impetus for them to sell because why would I sell and change into something that may be less advantageous? So they could continue to hold them, and that's going to go against the key plank of what the government wants. They're saying we're going to bring on the supply side, so property investors will demand new properties be built because they're going to demand that. They'll then sell out of their older properties and go to buy the new ones. I'm not sure that will happen because, again, supply demand economics says, well, since COVID, there's been a 30 to 40% time blowout of bringing new properties on, so there's less supply. Costs on average have increased about 5% a year. So we have a lot of property developments at the moment that are just uneconomical to bring forward underneath the existing cost base. So if we still have low supply, but now I'm increasing higher demand for investment properties that are brand new, or what's going to happen to prices of those properties? They're going to increase. So we may not see a little price depreciation on the existing hold because investors will still hold them. What you're doing is taking away a large chunk of the investor pool away from the established houses. So they're hoping that demand's going to reduce. As long as demand reduces less than what the supply comes on, you'll either see property prices hold the same, come off a little bit, or they may drop below what they're expecting. However, if you go and you read the analysis of what's done, if property prices are going up 5% a year, they expect these changes will drop that going up to 3%. So property prices won't come down, they just won't increase as fast. Still not going to help with affordability, still not going to help with supply. All you're doing is distorting the market. But we'll give them a crack and see what comes out, but I just don't think it's going to work.
Yeah, okay. Sorry, I'm just looking through because I had people contact me on Facebook because I put this on Facebook and I'm just having a look through because people also put boat under just one moment.
I've got a question if I can ask. It's on the
Please,
Go.
same
mate.
fire.
Please go. Yep.
Uh, yeah. Now I'm in that position where I've got a duplex investment property I've
hmm
had for 12 years, but I'm considering selling and buying more.
hmm
But now I'm thinking, do I need to hold this because it's already cash flow positive and it's great? Um, or do I, sell, which was my original plan? But is a knockdown rebuild considered a new home?
Yeah, it would be true. Because what you're looking at is you're going to knock down. So from that knockdown, you effectively have a vacant block of dirt, and then you're going to build a brand new house on it. So that would capture under the new rules. Being it's a brand new, that would be classified as a brand new property, and then you would classify that under the new rules.
Okay, great.
But with having an investment property, what you've just said as cash flow positive, well, you're in that enviable position where you can actually utilize the cash flow of that property to make catch up any shortfall on another property. And even if you bought an existing property, while you can't claim a tax deduction on the loss of that existing property against your taxable income, you can then actually offset that against the income from your other duplex. So, mate, you've got options. So, well done. That's an awesome result.
Okay, great. I'm still, yeah, considering what I need to do.
Yeah, and my terminology around those lines is what's your strategic direction? What are you trying to achieve? And when you have good clarity on what you're trying to achieve, you can then sit back and to say, well, okay, is selling the duplex going to get me closer to what I'm trying to achieve or further away from what I'm trying to achieve? If it's going to get you further away, well, you just don't do it. And if it's going to get you closer to, then you crunch the numbers. And that's a really quick and easy way to make decisions based on what you're trying to achieve. But get that clarity, mate. Get that clarity around your strategic direction of this is what I want to do. This is where I'm heading. Now, does selling that duplex get me closer to it? If not, don't do it. If it does, okay, what do the numbers now tell me to allow me to continue it on?
Great, thanks.
All right. Is there any more, Drew? Any more,
No,
Drew, or
that
you
that's
right?
it. That's it for now.
Okay, great.
Awesome.
Um, so Dan, one of the questions from Monica says, if you had to strip away the politics entirely, what are the two or three things in this budget that an independent economist would call like a good policy? And what could they call like the biggest risk? So what would be a great policy? What would be like the biggest risk?
I think at the end of the day, when you give tax deductions, or sorry, when you give tax cuts, that's the greatest, that gives benefit to people. So when I'm looking at that, it's like, well, okay, yes, we move from 16 to 15% as a tax rate for the next bracket after the tax-free threshold. And then the following year that drops from 15% to 14%. Right? So you're getting some coin back. The $1,000 work deduction, which means you just list $1,000 and then you get the tax back on that based on what your taxable income is. If it's 30 cents in the dollar, you get $300 back. If it's 37 cents in the dollar, you get $370 back. That all adds money into people's pockets. So you can't you you can't swing at that. Any money that comes back to us is, the government doesn't spend it well, so we might as well spend it. I don't like the tax changes. I don't think there's going to be too many unintended consequences that are going to flow through from it. And they're saying by 2034, 33, 34, or 34, 35, they're going to come back to a budget surplus. And that budget surplus is based on the fact that they're going to be able to save $32 billion in NDIS funding over the forward budget estimates. Now, when this came out, the policy was a good policy. The funding mechanism for it was never properly established, so they just brought it into the normal cash flow of the government. But what we have seen is it's grown exponentially year on year on year on year, and the government has made no headway into clawing that cost back. So to be able to say you're going to reduce spending by $32 billion over the forward estimates, where NDIS is one of our has grown to exceed the defence budget this financial year. The budget's underpinned by very, very shaky grounds. And if you don't achieve that, then we have forward deficits rolling into, I'll be retired well and truly by the time that this government would ever bring their budget back into balance.
But then you've also got the 32 Olympics, which is coming up too. So it just sort of seems like there's always going to be something that's going to blow the budget. Anyway, it
That's
always seems
that's
like there's something.
that's without oh my God happening. So listening to forward economists, yes, they believe GDP growth is going to reduce this year due to the fuel. They expect that that will pick up if it gets sorted. There's a big if. If it doesn't get sorted, well, the world's in a world of hurt. And it's not just a decrease in fuel supply, it's a decrease in fertilizer, it's decrease in neon gases that we need for our chips. There's a whole big flow-on effect that comes through that if it doesn't get sorted is going to constrain global growth dramatically. Just before I jumped on, I was talking to one of my cane farmer clients, and I was asking how the crop's looking this year, et cetera, et cetera. And he was saying that they may only get 80% of their fertilizer that they need to fertilize their crop. So you sit down and you go, I got demand here, I got low supply. Price goes up when I got high demand, low supply. You then look at the further effect on that is, well, I'm now going to get a less yield from my product. If I get less yield, I get less income. My costs are going up, I get less income. What happens to my income? And with farmers spending something like $25,000 to an acre to buy a cane farm up here, the decrease in the cane price and the increase in your production costs, which I call throughput costs, is effectively evaporating your profit. And that's before you actually pay the bank back. So over the last couple of years, a lot of farmers in the districts bought up farms, and they've got a huge debt level. With interest rates continue to rise, it's going to be ugly.
Okay. I hate always leaving on things
I
like that.
know, I know. Drew, just a question, mate. With your investment property, how are you situated with the interest rate rises that are coming?
I'm okay just because it's cash flow positive,
Yep.
but yeah, not happy about it.
No, because
It,
that
it
that that's eats
doesn't
into your
put,
profit.
yeah, that's right. But yeah, it doesn't put me on the edge, so I'm okay.
Okay. Sweet.
Daniel, that is actually, I've searched, that was all. Someone did just mention about the $1,000. How's that? Um, but I think you
There'll
already
be
mentioned.
there'll be a line item that you just put that the accountant will automatically do for you, or if you do it via MyGov, you just go into your deductions, put work deductions, put $1,000 in it
Okay.
without a receipt, without anything else, and then the government will just um, take that off your taxable income and give you a little bit of a return.
All right. And then what can people do? Because I know we've been talking about it is going to be quite tough at the moment. So apart from getting your budget, being aware of your capital allocation, working out what you're going to spend and how you're going to spend it, is there anything else that you would say, look, like this is one way that you could do to look after yourself or to support your family or
Becca Jane, it comes down to two things. To either balance the budget or to pay down debt, you do two things. One, increase income, two, reduce costs, right? There is no magical bullet out here to say, if you do this, you're going to be fine.
Mm,
You either increase your revenue by owning a cash flow positive property like Drew, or you own investments that don't have any debt against it, so it throws cash off you. You take on more work, or you look at your budgets and you strip all of the other costs out that you don't need, and you go bare bones for a little while. And this is what's always worried me for the people since Keating's recession that we had to have. So we came out of that in 93. We had a long so everyone born since 1993 has not actually been into either a recession or a downturn. We had the GFC in 2007, and China decided to buy all of our coal and iron ore that kept us out of a recession. Yes, we saw asset values decrease, especially in the stock market, not necessarily in the property market. We saw those assets value decrease, but we didn't see major job losses. We didn't see unemployment rise. We didn't see people losing houses. So it wasn't a recession per se. But if we get into where October the fuel excise comes off, so fuel's going to go back up 32 cents. So if we don't have this thing sorted out with Iran by the middle of June, well, then we're in a world of hurt. And I know you always love for me to be able to bring the unicorn chat in to say, but it's going to be okay. It won't be. And you can't sugarcoat that if if it doesn't open and global trade starts to come off, well, we're an exporting nation and we predominantly export raw materials. So if there's a recession and overseas countries aren't building shit, they don't need our coal and our iron ore to the levels that they need. We don't do anything else in the country per se. We dig shit up, we have koalas to cuddle, and we dumb down our universities. That's all Australia does. We don't do anything else. So if the rest of the world doesn't want to build stuff, they don't need the shit we dig up. If they're not building stuff, they can't afford to come and cuddle a koala. And then they're sitting down and saying, can we afford to send our kids to an Australian university from overseas? I always look at the downside risk. What do I need to do to protect people's downside risk? So if I'm trying to protect people's downside risk, it's I only buy what I need. I don't buy what I want. I only buy what I need. And it may only be a 3 to 6 month time frame, but being able to have capacity available. I'm going to use Drew's as an example. The fact that he's got a cash flow positive property, if we see the Australian economy start to suffer a little bit, the good thing is we still have such a high demand for investment properties that rents aren't going to come down much because there's such a high demand for it. Where it'll be impacted is the people who have borrowed 95% for their property. They're the poor bastards who are gonna get hit. And us as taxpayers, we're on the dime to the banks to make sure they're not out of pocket. But what it does is, it presents an opportunity for someone who's like Drew, who's got that cash flow positiveness and has got the cash flow. Well, if shit comes off and things get bad, you've got the ability to go in and buy things at a reduced price. It's like you go into Harvey Norman and they have a 40% off sale, so we go and buy stuff. Well, if we have a 40% off sale and you've got the spare cash, you've actually got the ability to go do stuff, as long as it's going to head you towards your strategic direction and what it tells you to do. So there's no there's no sugarcoating, but I've been saying this for a couple of years. And each year my clients come back to me and say, still hasn't fallen, Dan. No, it hasn't, but it will. And It won't take much for the rest of the world to go, oh shit, we're in a world of hurt. Then economies contract. And since we are predominantly a primary production exporting country, we'll get hit hard. And people aren't ready for it. And that's what worries me the most. So I was going to say to anyone, get ready. And if it doesn't happen and I'm incorrect, the worst thing that's going to happen for you is you're actually going to have some just in case money squirreled away. And that can't be a bad thing.
So maybe like what would you suggest for people to have like as a buffer? A percentage of their what percentage do
I
you?
and it always comes down to different things, right? By and large, 10 grand gets you out of most ills. By and large, 10 grand gets you out of most ills. I have some clients who want to have $50,000 of just in case money. And I sit there and I shake my head and say, your opportunity cost, but it's, yeah, but I sleep at night, Dan. So then you do it. I would, I would say at least have $10,000 squirreled, squirreled away in cash. I don't like some people have a redraw account on their home loan, so they've paid down their home loan. Well, I've still got 10 grand in there because I can draw it back up, right? It's no difference to having the money in an offset account and taking it out. The cash flow or the interest calculations are exactly the same. But have something that you can grab in the event that, oh shit, I need some money. And 10 grand will give you breathing room.
All right. Well, I hope you're not a smart ass and I hope it doesn't come true. Um, there's no more questions. I've checked. Um,
I
Drew,
just want to raise a
oh,
couple of things,
go.
if that's right. And Drew, if
Yeah.
you've got anything else, you can jump in. One of the things that I do look at with this budget, and I use this as an example, is governments control, and I'm going to nerd out here, Drew, so sorry. Governments control fiscal things. So fiscal loosening is putting money into the economy, and fiscal tightening is taking money out of the economy. At the moment, our government's fiscal loosening, so they're putting their foot on the accelerator to the economy. The Reserve Bank's looking at all the inflation that's been brought into our economy and that's been bred into it, and they're trying to put their foot on the brake by raising interest rates, right? At the next Reserve Board Bank meeting, they're going to raise rates again. So what we've got now, if we're looking at a car, is I've got the Australian government putting the accelerator down, and then I've got the Reserve Bank putting the brake on. And those two things don't work. It stuffs the engine up. And if the government's spending money and the Reserve Bank's saying we've got to reduce demand, so we're going to increase interest rates, it won't matter that much because the government's still spending money. So we're going to raise interest rates, and it may not have the impact that it should have because the government's still spending money. We've got a $30 billion deficit this year. That's $30 billion the government's putting into the economy, and the Reserve Bank's going, inflation's too high already, we've got to stop. All we can do is increase interest rates. That's the little bit that I don't like about the budget. So I'm not too keen on that. I'm thinking we're in a world of hurt with that. We did have a couple of surpluses a couple of years ago, but that was more due to an increase in demand for our coal and our iron ore. Then we saw that easing a little bit, so less revenue came in, more spending, and now for the next 8 years we've got budget deficits. Budget deficits are typically inflationary. So, I hope I'm wrong, but I'd just err on the side of conservatism if I was everyone.
Yeah, I
Can I
think
just
I've
ask one more
frozen.
question?
Sure, brother.
Now, with the capital gains tax, can you explain the new rules when it comes to share holding and selling shares? And also, how does that affect a mutual fund? So I
So
buy into a
that's a
fund.
managed fund.
Yeah. Yeah, managed fund. Yeah.
So a lot of the talk at the moment has just been around the property. I'm assuming they're going to do the same thing with shares, being that it's going to be an index-based thing from a capital growth perspective. Now, so from an inflation base, they're going to raise cost basis by inflation instead of just saying, this is what I bought it for, this is what I sold it for, divide it by two, and off we go. So it's going to impact the same way that they're looking at the new properties, at the new property tax. Within a managed fund, so I suppose there's two things. One, the managed fund will worry about the tax within its fund itself, and that'll usually get taxed at a 30 cents in the tax rate. Or unless the government says it's not a small business, so most of them will be at a 30% in a tax rate. Your distributions that will come out to you, there will be a proportion of capital gains that the funds have bought and sold. So there's those capital gains that get triggered. They're going to flow out to you. So you would have to look at an indexing, and then there's going to be the flat 30. They're going to say, the 30-cent tax capital gain. And then there's going to be the gains that you make buying and selling your managed funds yourself, whether you take it to put into a new position or take it to take the money out, however that is, there will be the indexation rate as we go, and then it'll be at least 30 cents in the dollar as a CGT rate that you pay. And if your marginal tax rate's more on that, then you're going to pay more. They're just thieving bastards.
That's true. Thank you.
And I don't like it. We as a country need to have people not blowing smoke up your skirt, mate, like yourself, who actually want to get ahead, because that means you're not reliant upon the government. Yet what they're doing is they're taking away the aspiration of people to get ahead, which makes them more reliant on the government. And as a government, we can't afford that. That's why they've increased the superannuation guarantee up to 12%. And I'm assuming you're a lot older, mate, because you have a property, but my youngest boy turned 18, or he's 20 now, but pretty much for all of his working life, he'll be earning at least 12% of his salary goes to superannuation. So, by the time he retires, he'll probably have about $3 million in super. But it's going to be the people who are from 45 onwards who haven't had that. They're the ones that the government's strangling, and they're the ones that are going to be the worst impacted by the changes to the budget.
Yep, you're right on there.
Awesome. Becca Jane.
So Daniel, unless you have any other, is there any parting words that you'd like to give to people about this budget, or you feel like you're complete?
It's got to get passed first. They can get it through the House of Representatives, and then they've got to get it through the Senate. So a lot of things have got to get passed. Some of the changes that they've done have gone too far, and I really don't like the fact that they took these changes to two elections and got voted down. And then when they realized that they had the majority and a quid pro quo that could come through to the Greens could get most of them through, that they decided to do it. So, yes, we've got to make our plans based on what we know, but they've also got to get approved. So I wouldn't go basing my economic decisions on what the old scheme was. We still have to base them on what the new one is, but they've got to get approved. And if they get approved and how they get approved, well, we'll just have to wait and see. There'll probably be some amendments that come through. Whether they're good amendments or bad, don't know.
We
All I
don't
know,
have.
Becca Jane, is the tax module I had for the long game, I now have to rewrite thanks to these bastards.
Oh, well, it makes you have to do some work.
More
Well,
work.
Dan, thanks for that. I'll let the people know. So I'll send this out to everyone. And whoever asks a question, I'll make sure that they let that know. Hey, sorry, Drew. Um, we are also, I don't know if you've seen, Drew, we're on Facebook and Instagram under Resolute U. We also do like some podcasts around economic updates. So if you'd love to follow or subscribe to our YouTube channel, we'd love to have you. Daniel, thank you for your time tonight. Really appreciate it. So does
Thank you.
everyone that
Can I
wrote.
just can I just ask another question
To who?
to Drew?
Oh,
Drew, how did you find out about this, mate? Because I'm old, so I have no idea about this social marketing. This I don't have Facebook, I don't have Instagram. Becca Jane runs all of that for me. How did you find out about this? What caught your
Uh,
eye?
it was a community Facebook group, and someone else was asking about financial advisors, and a lot of them recommended you guys. I clicked through onto your Facebook page, and then I saw this come up, so I registered for that.
Oh,
amazing.
awesome. Wow, that's awesome. Great. Thank
You
you,
guys are
brother.
on the Central Coast, right?
No, no, we're so
Or-
so I live on the Sunshine Coast. I work in Mackay,
Okay,
and
okay, right.
Becca's on down the Gold Coast.
Okay, right. No worries.
Awesome.
Amazing.
Thank you,
And
mate. I
thank you, Drew,
appreciate it, eh?
for showing up.
Thank you.
It's good.
Did I answer all your questions, mate?
Yeah, that was great. Thank you.
Awesome. No worries.
Thanks.
Thanks very much.
Okay.
Okay, Becca
Bye.
Jane.
See you soon. Speak
Thanks,
soon.
Drew. Thanks,
Bye.
Becca. Bye.
Uh,